And yeah, not necessarily something that you want to get back from a long weekend to go through a lot of learning. But I think this session is going to be quite light. It's a bit of a challenge putting this training materials together because the year-end closing process is so much, and we only have an hour to go through it. Even if we had a whole day, it's probably not enough to cover every single area of the closing. So it'll be a bit high level. Uh, and then also with the year-end closing process, that also comes with audit preparedness. As you do a better close, the audit just becomes a lot easier. And the end goal is having a happier holiday season and enjoying Thanksgiving, Christmas, and whatever holidays you celebrate. So I like to think of the year-end close process as an annual process. So it's not necessarily something that you just do at year end, or maybe not something you're supposed to just be doing at year end. It's really an annual close, things that you do go through throughout the year. And the first step is to prepare a financial close schedule, to have something formal, something that you have a complete inventory of everything that needs to be recorded to close the books, and also includes due dates of when you want things to be accomplished, who needs to perform those steps, other departments, which personnel in your staff are responsible, and also who's going to review or supervise that process. You can also include uh, monthly or quarterly meetings to go over the close or anything that needs to be caught up. It's not necessarily that you want to wait right at year end, starting from, I guess, this month and going through all the way up to October. It may not be enough time before your audit starts. The second step is gathering financial documents. For these processes, you want to identify what reports need to be run, what type of external documents you need to gather, some information you need to obtain from actuaries or other consultants. Also in this process is your full ACFR, so getting your statistical information, anything else that you need for your close. Review and reconcile all accounts. So I think during the year, there's a lot of focus on your revenues and expense accounts. These are usually very easy for you. You review them and process them frequently. However, a lot of times you forget about the balance sheet. So receivables, earned revenues, accounts payable, capital assets, these are all left till the end. Sometimes we are the ones who identify them for our clients that this account didn't really change. And then that's when we get audit adjustments, additional closing entries, additional delays in the process. This is an important step, is to prepare and review financial reports and also financial results. Not only that you want to go through and record all your entries, but you also want to have time to run reports, review your funds, are things in expectation of what you expected. If you had expected to have a lot of expenditures in a certain fund, was that what you see, or is there's a sign of potential errors? It's not, it's quite often during the start of our audit, we do our preliminary analytical procedures where we'll compare current year results to prior year results. And we'll send it at the start of the audit. And we don't really hear anything from our clients. Not all our clients. I don't necessarily put everybody on blast here. But it's not often that we don't hear from them. And then through the audit, we start getting a few entries. We'd like to adjust prepaids. We'd like to adjust this receivable. We'd like to adjust this. And then we finally get the responses to our analytical at a few weeks later. And the explanations are like, well, there is no more variance. Review journal entry this, review journal entry that. So by that time, it's really too late. Any of these adjustments are really considered to be audit adjustments as they've been detected by our audit and not necessarily something that you identified. So I do get one, our clients, a few of our clients do this process. And it's an easy way to really avoid audit adjustments and really complete your close. Excuse my mouth's a bit dry from just allergies. So it's, all right. Make sure I bring a glass of water. Uh, you want to prepare and accumulate your audit schedules. So the audit schedules, our request list would include, things that you normally would prepare as part of your close anyway, your accounts payable schedules, capital asset schedules, long-term debt. Uh, our audit request list is not a closing checklist. So I think I had one time a client refer to our requested list as our closing, like when will you provide our closing procedures, and really our audit request list, even though it will have a lot of things that you would prepare as part of the close, it's not going to be an all-encompassing list. It won't include immaterial items, and also we're not part of your organization, so we wouldn't know every single entry that needs to be recorded. So that is something to think about. And lastly, you need to close out the accounting, and that's really when we receive the audited trial balance, and then we start the audit at this point. So this is all prior to the start of the audit. Just something you want to think about. Not that you want to do everything all at once, and that's why I mentioned, this is something that you want to be thinking about throughout the year, something you want to start on early, and something you want to have documented. All right, and this is just an example of a closing checklist. It's not necessarily everything that needs to be here. You can organize it somewhat differently. At the end of the presentation, I do have a link uh, from some materials from the GFOA, some examples. I believe they have a couple of cities, checklists, calendars, and other materials. But you can see here they have identified what report is needed. They've set a due date for when that item needs to be completed, who's going to be completing it within the organization, any kind of notes, and then whether that task has been completed yet or not. So not very complex, and I think that's usually something that causes everyone to procrastinate. This is sometimes when we imagine things are too difficult or needs to be very advanced or perfect, that just prevents us from starting in the first place. So you can start off with something simple if you don't have a closing checklist. Just go through, start putting your thoughts together, and then add more information as needed. Okay. All right. So key areas to focus on. So you want to identify uh, your main accounts, and this is not an all-encompassing list, as it's impossible to go through this. But the key assets would be cash and investments, receivables, a variety of different types of receivables. You have your prepaid items, deposits, other significant assets. And then, of course, the large one, which really causes a lot of delay, is capital assets. I'm sure all of you can imagine the work that takes to build your capital assets that needs to be. So we'll talk about these areas in more detail, what significant items you need to think about, what are the common errors, what are some of the challenges, and hopefully some potential solutions that can help. Right? In terms of liabilities, you have accounts payable and other related types of payables that come with accounts payable. You have accrued payroll or other related pays. You have deposits payable is can be significant. Unearned revenues for some can be a significant item. Pension and OPEB, which pension and OPEB, even though it's a complex accounting area, especially when it comes to the actual preparation of the actual study itself, which sure Katerina can speak to, once you have the actuarial study, the journal entries that you need to record are not that complex. They are really routine. Once you have something documented or some kind of work paper, it can become something that's actually one of your easier entries that you need to prepare each year. And then long-term debt, it can be significant for some. Some maybe it's a bit easier if you don't have too much debt to worry about. Revenues and expenses, it can be a bit of a maybe not an area that's prone to errors, especially if you're looking at mainly the errors with revenues and expenses come with the assets and liability side. So if you're missing accruals, that's really when it's going to cause you to have issues with your revenues and expenses. Really, the clients that have no issue with the revenues and expenses, or at least the revenues, are they prepare for the significant revenues, they will have some kind of work paper that kind of reconciles the revenue for the year, and that really makes sure that they didn't miss anything or double record anything. So actually one point I do want to mention is that I didn't really think about the closing checklist in this way, but I was talking with the client and they did mention it, is that usually when our concern with the closing checklist is about completeness, so you generally think about, did we record that? Did we not record this? But an issue that she mentioned was that she would often double record items because she started the close in July and then something happens. She's now going back and continuing the close in August, and she forgot that she already recorded a few things. And then in August, she records it again. And then during the audit, it gets discovered that, why did the receivables go up so high, or why did the AP go up so high? And it's identified that, oh, I booked this revenue twice. So that can also help here in performing these reconciliations. Cost allocations. So cost allocations are and other types of journal entries that are really entries that if you don't have them written down, you'll probably forget that they need to be recorded because there's nothing that would trigger an error or an issue unless you do some kind of financial analysis. So any types of allocation entries, you want to include that as part of your close. Capital project funding, even though this can be, depending on your ERP system, it can be something that's behind the scenes. You may have a different project reporting module, but there's a lot of work that goes into identifying capital projects, which funds pay for each project, ensuring that the additional coding that happens behind the scenes is going to the right place. So that's often an area that we see errors, or we see subsequent journal entries because we may not be aware of all the different facts about the project. So this is one thing to consider. And then lastly, fund balance and some other items. So, deficit fund balances. So any funds that have a deficit, those funds need to be reviewed. Net investment capital assets. Even though this is something we assist our clients with if we're preparing the financial statements, it is something that really comes from management, and we expect management to take ownership of it. So it is something you want to look at when you're preparing your closing. Fund balance classifications. So generally, in your general ledger, you don't have the GASB 54 fund balance classifications. Some do, but you do want to make sure that, especially for funds that have multiple funding sources, that you do classify the ending equity in the appropriate classification. And then internal borrowings and transfers. So anytime a fund borrowed from another fund, if you have negative cash issues, this is something to consider. And also transfers are another, similar to cost allocations. If there's nothing that triggers you to record them and you don't have it written down, it's often an entry that gets forgotten. So we'll go over these different areas in in detail. So moving on to cash investments. So a big item with cash investments, definitely with cash, is the bank reconciliations. And depending how good you are, uh, this is, can be a lot of work. So, key documents that you want to incorporate into your closing checklist to make sure you identify all the accounts, obtaining bank statements, information that's needed for significant reconciling items. So your outstanding checks, your deposits in transit, and then also a reconciliation of your pooled cash accounts if you do have a pooled cash fund, or you have pooled cash uh, control accounts somewhere in the general fund or some other funds. Forgot to mention, probably the reconciliation itself should be prepared. If you have investment accounts, so you do want to include obtaining the investment statements from your custodians or brokers. This would include also other investments that may be restricted, such as your PARs, trust statements, the analysis of the account. So you do want to analyze the transactions within the statement. What went, what were the additions? What were the sales? What did the broker or custodian do with the funds that were sent? And also, you want to consider compliance with the investment policy, even though they usually are provided with a copy of the investment policy. At the end of the day, you're eventually responsible for that. And it's usually something that, as part of the audit, we'll be looking at as well. Interest income allocation. So this is something that you want to include as part of your closing schedule, is always allocating that interest to the different funds and having a methodology to prepare that. Not sure why it's kind of doing that, but trust accounts. So you also want to make sure you include your trust accounts for all debts that you have outstanding. So if you have project accounts, reserve accounts, or just generally, I'm sure you have some monies with Union Bank, US Bank, and so forth. And these require manual reconciliations or separate reconciliation from your checking account, savings account. It's often that we find that these accounts are not adjusted, and then we end up proposing an audit adjustment for them. And then a reconciliation of the account activity. So whatever happened during the month or the year, make sure that is reconciled. Right. Other significant investment entries. So you do have a fair value adjustment entry that needs to be recorded. And this is something that either it's left to the auditors or maybe not recorded accurately all the time. But it's something that we often find that sometimes it gets double recorded. But you also want to consider your interest receivable accrual. So that would look at your subsequent interest payments, or looking at the custodian statement, or if you have a software that estimates interest receivable, that's something that you want to include as part of your cash and investments closing. Right? So challenges and errors that we see when we do the audit. So timeliness of the reconciliation is a big issue. Not a big issue, I guess. It becomes a big issue when you have challenges. And this challenges, the causes are generally you have turnover, you have new ERP system implementations, you're playing to catch up. So you have a lot of things going on. At some point, the bank reconciliations get put on the back burner as you're trying to catch your breath. But it can become a really difficult area, especially if you're really behind. Yes, Rich.
2% below what the stated value of the investment was. In the last couple of months, that percentage has actually been greater than 100%. Okay, which is a big thing as far as I'm concerned. But if the fair value is actually greater than 100%, I would assume that we take that difference, and that becomes part of interest income for that year. Is that correct?
Yeah, fair value factor, if I'm understand, and the question, just to repeat it, is that, what do you do with the other side of the fair value adjustment, and where does it get reflected? So when you're adjusting your investment balance, where does it get, what is the other side of that entry? And the unrealized gain or loss, generally, yeah, it gets reflected with and netted with investment income. And sometimes you may have a separate account in your books for capturing that adjustment. So that's why it's kept separate from other interest income that you've recorded on a cash basis. Adjustment factor greater than 100% seems odd, unless you mean that it's 102% of the cost.
Yeah.
Yeah.
We get monthly reports of what the treasurer's portfolio values are, and over the past 2 months, it's been greater than 100%, which is
Right. So that, yes, the other side of the entry would be to your unrealized gain. Yes, referred to as an unrealized gain or loss. Essentially, it's an expected gain that will occur once eventually that investment matures or the interest gets paid. But yeah, as I was referring to the bank reconciliations, you don't want this to fall behind. I'm dealing with one audit. They're still we're still completing the 2023 audit, and they've fallen way behind with their bank reconciliations. And they've taken action now by getting a consultant on board to just focus on bank reconciliations and get them really caught up. Bank reconciliations is also a very important internal control for identifying any errors or put issues with fraud, perhaps if you may have fallen victim to any kind of phishing scheme or where someone else has gotten access to your account and somehow or fooled somebody to wire monies in an inappropriate way. But otherwise, I just want to ensure reconciliations are being performed monthly. So if you're falling behind, take some course of action to get caught up. All right, pooled cash and investments. And this is where it's often can be a challenging area, is that you have control accounts in your trial balance for your checking account, for your savings account. And generally what we find is that these control accounts are being reconciled. So you are verifying that your adjusted checking account balance agrees and reconciles back to your bank statements. However, when you're looking at pooled cash, there is a distribution of that cash to each fund. So what happens is that when we come and start the audit, we take all the cash accounts that are in the trial balance and try to prepare a summary or a reconciliation of these amounts back to the trial balance. And what we often find is that this doesn't balance. So even though you may have balance to the control accounts, the entity-wide cash and investments don't balance. So what you want to probably do as part of your, either as on a frequent basis throughout the year or just at the end of the year, is also to prepare a cash and investment summary of all your cash and investment accounts and verify that they agree to the trial balance. This just ensures that what is reflected in the financial statements will be your true cash and investment. Right. Negative cash. So often funds may have a negative cash balance, which may be fine, but it does require analysis to identify why is that fund reporting a negative cash. It could be indicative of some errors. Perhaps a revenue has not been recorded or a transfer has not been recorded. Is there a receivable that will replenish that negative cash or some kind of future revenue that'll come in to replenish the cash. If not, you may need to do some kind of other adjustment or correction of prior years, perhaps, whatever. Uh, it's not necessarily appropriate to automatically assume that it's a due to, due from, whereas the internal borrowing with the general fund, that can create a problem for the general fund where it has receivables that don't repay. As I was mentioning, trust accounts not adjusted. So often we find for some of our challenge clients that their cash investments were all balanced, but they kind of forgot about restricted cash, which you may include monies for your conduit debt, for project accounts, and then we have to propose an entry. Okay, well, you need to adjust this account. Um, so you need to include these accounts as part of your annual closing. Right. So that's all I'll have for cash investments. Just make sure I'm doing okay the time. All right. So going over receivables, key items is obviously your big one will be your accounts receivables. You want to generate aging reports or customer, some kind of listing of all your receivables from your subledgers. Sometimes these don't always agree back to your trial balance. So you need to prepare some kind of reconciliation to the subledger. You don't necessarily just want to true up the amounts because sometimes it could be indicative of some other issues that are going on, especially if these true ups are getting larger and larger. Uh, you want to make sure that you understand what's happening in the subledger and how is that getting reflected in the general ledger. So you want to sometimes prepare a reconciliation of identifying what's causing those variances, and if any entries are needed after preparing those reconciliations. Some of these systems, I think nowadays is probably not the case with the newer ERP systems, but with more older softwares, the aging reports need to be run on June 30th exactly. So if you're not able to run them exactly on June 30th, then that creates more variances between the general ledger and the subledger, which you may need to then kind of go through other reports, payments that happened subsequently, or what were the additional billings that were recorded and posted back, and so forth. This becomes a bit of a mess. One thing I did forget to include here is manual accruals. So any types of subsequent collections that you need to book. Generally, you'll also have another schedule of manually accrued receivables, which can be customer related if you're not running them through a billing type of process. Yeah, the second significant receivable is your grant receivables. Um, and this is an area that we find that there are misstatements, is you need to have a schedule of all your outstanding reimbursements. So, what grants, billings have been performed, and have a schedule by fund, maybe with some significant details, such as the grant name, when was the remittance when was the billing performed, the amount, of course, and then also if it has been, when was it collected, if it has been collected. Schedule of subsequent collections. And then also, this is one a big area that we find errors is unbilled grant expenditures. So the receivable is really recognized at the point where you've met all the grant requirements that the grantor now owes you a reimbursement. So that happens when you've met all the significant eligibility criteria of that grant, which would include, for most of the reimbursement type grants, is incurring the expenditures. So once you have project expenditures, if there are obviously some minuscule requirements such as preparing the reimbursement request, but that doesn't defer you from actually recognizing a receivable. So you need to usually, if you have grant funds that are funded on a reimbursement basis, evaluation if there are any unbilled grant expenditures. So if your last billing was in April and you've incurred expenditures up to June, there is a receivable there technically that you need to accrue. Okay. Yes.
California, learning where you had a approved grant, met all the conditions of the grant, submitted paperwork for reimbursement, payment or wherever it's supposed to come from, and all of a sudden, there's a big question on whether you're going to actually get paid. Okay, because the federal government's blocking grant funds from putting based on talk. Okay, what do you think about this? What you adjust the receivable? You have to write it off, or because this is such a timely subject that the ability whether you're going to actually get those funds becomes a question. From the point of view, how would you suggest something like that?
Got it. Thank you, Rich, for your question. So just to repeat the question for everyone, the question is, what do you do when you have concerns about collectability of a grant, or with that, I guess, with any other types of receivable that you may have? And that's really where you may want to consider recording an allowance for uncollectible amounts, where maybe you don't want to write off the grant receivable completely, where you still have it in your general ledger so you can keep track of it and you know that it's there. But you may want to consider recording an allowance for uncollectible amounts, just because, especially in a situation where it's probably more likely than not you're not going to collect it. If you still believe you'll collect it but just have a little bit of uncertainty, it's probably not the right time to write it off at that point. But if you know that more likely than not you're not going to collect it, that's probably when you want to record an allowance and remove it from your uh, financial statements, especially if that's you're making decisions that you will collect it, that you'll probably be making wrong decisions there. Also, materiality is an important factor. If it's immaterial, you may want to let it go. If it's a very material amount, it is important to the reader to know that this receivable may not be coming in. So don't make any financial decisions assuming it will be collected. Thank you, Rich. Other significant receivables are your notes, loans, receivables. So we generally, this is not a schedule we see for all our clients. Most of our clients prepare a schedule that's just a listing of the balances as of the end of the year. However, best practice, probably you want to prepare some kind of roll forward analysis of your long-term receivables that has your balance from the prior year, what were your new loans, what were the loan repayments, what were the loan write-offs or other kind of corrections, and what's the balance at the end of next year, at the end of this year, sorry. You also want to reconcile your loan disbursement and loan repayment accounts. So if you've issued loans and you've been recording those as expenditures throughout the year, those those accounts, you should be able to reconcile them to the additions. Similarly, loan repayments, you want to be able to reconcile those back to uh, your deduction to the account. And this is assuming that throughout the year you use these expenditure and revenue accounts to account for these loan activities, which is generally the practice for most of our clients, which are then adjusted at the end of the year. If you are recording these directly as you receive them or disperse them, then that's not necessarily as important of an issue. Reviewing your loan agreements to make sure that the terms of the loan dictate how much is really receivable, if anything is forgivable. And then also, if you use some kind of third party to manage your loans and they provide you with the report of the balances at the end of the year, similar to other external reporting, you don't necessarily just want to true up the balance to what's reflected on those schedules. You really want to reconcile those schedules, understand what were the activities that happened during the year, and make sure that reflects what actually is in your books as well. Unbilled utility is if you have utility funds such as your water, sewer, or other types of utilities, you do generally need to think about unbilled utility receivables, and especially if you have multiple routes that are being done, and you have multiple billing, uh, like you're not necessarily billing everybody at once, which I think for our smaller clients, it is something that's possible nowadays with newer technology that with the click of a button, you can get all the reads immediately. So this becomes less of an issue. But if you're not in this situation, you do need to prepare some kind of or consider what is the unbilled utility revenues. Generally, the last read for a customer is usually not done exactly on June 30th. So what's reflected in the utility billing system as far as receivables are concerned is what was their last receivable based on that billing date. So if their last billing that was done was in June 20th, they have 10 days technically of consumption that they did not, you haven't reflected as a receivable yet. So you have to look at the subsequent billing registers, and most likely it's not going to be an exact science because you don't know day by day how much that customer actually used, but you're just prorating, based on 10 days of consumption divided by 30 days. When the next billing occurs, you prorate and record some revenue back to the prior year. Okay, so that's essentially what this unbilled utility accrual is for, and anything similar to these. So these are just the main areas. It's not necessarily an all-encompassing list of everything that you may have, but I'm sure you can think of other things as well. Right, just a few more things, and we're going to talk about allowance as well. So you need to have consider collectibility as part of your receivables. So generally, you want to get an aging report and review those aging reports for outstanding or delinquent receivables. I have here XX days, not necessarily any specific day. Generally, you know your organization, you know how what are your payment terms. So depending on what your payment terms are, that's something you want to look at. And then consider writing off anything that wasn't collected or as significantly pending. Okay, and then some other miscellaneous items. So you may have contractually related receivable amounts. So your organization may have some kind of agreement with the neighboring organization where you get reimbursed, or you have something other types of arrangements where you need to account for a kind of manual, a kind of invoice that does get sent out every year. For loans receivables that might also require an allowance. And then also you need to consider availability for your governmental funds. So governmental funds, as far as revenue recognition is concerned, there is an aspect of availability as to whether those monies are really going to be available to spend in the next accounting period or next fiscal year. So anything that's really outstanding in September, October that you haven't really collected, it's not really appropriate to recognize the revenue in this situation. You want to defer those revenues into an account that's referred to as unavailable revenue. So this is something that obviously you can't necessarily prepare in August or July. You'll need to wait. So that's when you're preparing your closing schedule. It's something that you want to put in there in the appropriate time period. So challenges and errors, reconciling receivable control accounts. Apologize for the graphic for anybody who's essentially you need to run an aging report. These are all aging and have technical issues. So you want to make sure these aging reports reconcile to the control accounts. It's often we get the aging reports on our organizer, which is our document exchange portal, and these reports don't reconcile back to the trial balance. And I was like, I requested it, but I was hoping it also agrees. And then the challenges are that also you may have multiple systems. You may have something that you use for water. You may have something that you use for sewer. You have something else used for miscellaneous receivables. All of these systems have their own reports, have accounts, activity that's happening outside of your general ledger. So preparing reconciliations for all reports, all systems is important. And it's important to maybe do this. If you're having a lot of challenges in reconciling these reports, then maybe you want to consider doing intermediary reconciliations. So instead of waiting until the end of the year and then identifying, oh, this report is off by 100,000, and then you have to kind of go through from July all the way to June to figure out, where did the issue happen. You can just prepare a monthly reconciliation, and that's really where you can track, okay, are we having an issue or not? Do we need to go back and take a closer look at this? That's helped some of our clients. Missing accruals. So again, this is something where because the analysis is not necessarily being prepared, we often find that we get we get external reports from the CDTFA for sales tax. We get confirmations from third parties. So when we're reconciling the revenues, we often find that they're missing accruals. Often accounting have challenges because your grant billings are decentralized. So you're not aware of a grant billing that Public Works may have sent out or Community Development may have sent out. They send it out on their own. You only discover or hear about it once the check comes in, and then it usually starts a discussion of like, do you know what this check is for? Where do we need, which fund do we need to record it in? So usually if you have a grant policy, within that grant policy, you can include some requirements for grant billings. So you could have all the grant billings funneled through accounting. So accounting keeps track of all the grant billings. And that kind of makes you aware of what's out there and doesn't leave you open to surprises. Unavailable revenues is another area where we find mistakes. There's no receive. I think a kind of confusing item for some is that, well, we didn't receive this within the 60 days, so that's why we don't have the receivable. But the requirement only falls for, or only applies to revenues. The receivable is recognized regardless of whether you collected it within 60 days or not. So you'd always have the receivable in there. It's just that you would be deferring the revenue. The revenues are not appropriately deferred, so it's either that it's just by maybe it's a revenue you always collected within 60 days, so it was never an issue, but somehow this year there's no reimbursement hasn't come in, or the billing didn't even go out, so you incorrectly recognize this amount as receivable, even though there was no collection yet, or the collection was significantly late. And then prior year unavailable revenues are not reversed. Because this entry is usually a manual adjustment done at the end of the year, excuse me, it's usually something that can be forgotten, that you need to manually reverse this entry. And also, you should only reverse the entry if you've received the revenue, because what happens is that the payment eventually comes in, and then you debit cash and credit revenues, but you need to remember that there's also a receivable and unavailable revenue that also needs to be kind of adjusted here. Allowance for uncollectible accounts is unadjusted, or doesn't seem appropriate. So you do want to look at your aging reports and investigate the delinquent balances and understand them. Sometimes it's fine to have something that's very delinquent if you've maybe entered into some kind of repayment agreement with the other, with the whoever owes you the monies, that the receivable may still show that it's really delinquent based on its original inception date, but they've been making payments, so it's maybe not automatic that it needs the allowance. And then also it doesn't, this also may be, you may also have delinquent amounts there because you did receive the payment, but when you received the payment, you didn't apply it to the receivable. So you just debited cash and credited revenue, but you didn't actually apply it to the receivable. So then the receivable didn't get adjusted. So it's something that where if you haven't looked at this for a long time and you do this exercise, you may find that actually a lot of the receivables that are in your aging reports may have been collected a long time ago, and there's really nothing that you need to worry about. All right. I think I may need to speed up here. So moving on to prepaids, and prepaids and deposits. There's really not much to talk about here because usually they're an immaterial item, and probably I won't spend too much time here. But generally, you want to go through your common recurring expenditures, what usually applies for the following fiscal year. Usually, it's not exactly by fiscal year, so maybe you want to look at only the invoices or expenditures that have a majority of the service period in the following fiscal year. Like sometimes it's just based on a calendar basis, so 50% of the invoices in the current year, 50% is in the next year. Um, and then you want to have some kind of schedule by fund and with some kind of description as to the nature of that prepaid. Deposits is similarly, usually not a lot of activity there, just a general description of what are those deposits, some kind of investigation if those deposits may have changed, if or there needs to be a change recorded for them, and then have any support for any new deposits. Another significant item for cities, maybe property held for resale. So also another area, unless you're very active with your developments, can be something that stays static for a long period, but you really want to kind of go through and investigate if there was any property sales that you may not know about that you need to account for. And you also generally want to keep with your journal entry the support for those sales or acquisitions during the year. Common challenges, generally we find that these accounts are just not adjusted, and generally it's just overlooked because they're immaterial, or there's not a lot of activity going on in there, so they're easily forgotten. So just make sure you include these to analyze them annually. Moving on to capital assets. So I have probably a lot of information that you have to generate that are just summarized into a couple of bullet points here. So it's maybe not reflective of actual work that it takes to put these things together. But generally, you want a roll forward analysis put together. So you want to take a look at your capital assets as of end of last year. What were the current year capital asset acquisitions? What were the current year disposals, impairments? Um, and then also you want to analyze this by reporting unit. So if you have a water fund, a transit fund, a sewer fund, what have you, internal service funds, you want to look at and prepare these schedules for each reporting unit ideally. Generally, there are some subledger reports that you generate or you have to prepare if you don't have a system that accounts for this. And key information in there would be the cost, accumulated depreciation, the depreciation expense, acquisition date, um, if there was a sale date, a listing of current year acquisitions, so a report to support the additions during the year, a listing of the disposals during the year, and then analysis of construction in progress. So these are the key documents. You may have more things that you need to put together than this, but these are usually the key documents. Here's some other things to consider: schedule of sales or auctions, listing of donated or contributed capital assets, and then if you have donated capital assets, then you want to consider how do you measure the value of that asset. So GASB requires that you measure those at the acquisition value, which is really if you were to obtain this asset today, what would be the cost of that? These are non-cash transactions. Anytime that you have some kind of non-cash type of activity, leases or what have you, there are going to be omissions because it's not something that you actually have in the general ledger. It's something you need to put in the general ledger. So common things we find, errors on the reconciliation. So usually we find there's a lot of Excel worksheets involved with capital assets. So with that comes formula errors. It's not often gotten into a lot of debate with clients about the wrong, a missing row that wasn't in the sum, or somehow something got double counted, and especially if it wasn't something that was identified in previous years and some kind of prior year correction is needed. Consider using a software solution. So anytime if you do have an ERP that has a capital asset module, that usually makes things a lot easier because there are a lot of controls that can be set up in the system itself. And then create check totals or other validation checks. It's something that's you're going to have a high volume of transactions usually. You have equipment purchases, land purchases, like land probably not so much, but capital projects. You need to kind of check in with departments if they had any disposals. So generally a lot of things that if you wait till uh, October to work on it, you're going to really cause a lot of delays. So if you can do something in, monthly, quarterly, or even semi-annually, it'll help you a lot. Another key area where we find errors is capital project activity. Um, you know, there are challenges from contractors. They don't submit their invoices on time that causes issues. Uh, you also have completed projects that you haven't appropriately reclassified out. So you want to maybe talk and involve your project managers when you're kind of going and updating capital assets or construction in progress. Other common errors, just the beginning balances not agreeing to prior year. So maybe there are subsequent corrections or something happened where now your beginning balance of your roll forward schedules don't agree back to your prior year financial statements. Whatever the reasoning, you want to account for that. Donated or contributed assets are missing. And then also what's often forgotten are your lease assets and your SPIDAs. These are also considered capital assets. So you want to include them somehow in this area. All right. Just moving on to liabilities here. So you have accounts payable. Generally, probably not a very uncommon area for most of you. Generally, you're going to have some kind of system report of your accounts payable, some kind of reconciliation similarly to your receivables, reviewing your subsequent disbursements for anything that needs to be accrued back. And then also you'd have to prepare some kind of schedule. If you're manually accruing things back to the prior year, you want to prepare some kind of template of what are those accruals, what is the vendor, what is the check or invoice number, something that can reconcile back to your trial balance. Retention payable is something you want to consider. Depending how you record retention payable throughout the year, I think different agencies do it differently depending on the volume of capital projects. So often if you're starting a project and finishing the project during the year, usually it's not an issue because the expense is going to be the same whether you recorded retention or not. But you do want to have some kind of consideration if you have capital projects that are unfinished, what is the retention payable at the end of the year? So common issues are missing accruals, and that can happen from a number of reasons. Vendors don't submit their invoices, or the department is holding on to an invoice and haven't informed you about it. Consider estimates for anything that you may be able to estimate, because really a contractor not submitting their invoice timely is a bit out of your control, but also at the same time, the accounting rules require you to accrue something for what you need to pay. The 60-day rule isn't really an argument for payables. You can review like your capital projects. If you paid for your large capital projects, if you know that the last invoicing that they did was up to May, then you should expect that there's one more at least coming for June. Comparing accruals prior to current year, you may have reconciling errors between your AP reports. So similar issues with whenever you have subledgers involved. Gonna see, I might need to, okay, I think I'm okay. All right. So accrued payroll and other key items. So this can be an easy item. You just need your subsequent payroll register. Sometimes these things are done by the system, so you can set up your system to accrue payroll, and usually that's a more accurate way of doing it. For those automated accrued payroll entries, you normally prepare some kind of reconciliation of payroll expense to make sure that what hit in the current year plus what hit in the following year agree back to your total payroll. And then also consider other payroll accounts that you need to reconcile, and then also any other payroll-related pays, such as employer taxes and so forth, that need to be included in here. Also, compensate absences is another significant item, generating system reports of these balances, especially this year with the implementation of the new GASB. You have a calculation of the balances. You want to consider what are your policies. So having copies of your policies or reviewing those policies annually as part of the process is a good idea, especially if you have a new MOU. There may be changes in what was promised, so you have to tweak your calculations. Consideration of what's the short-term portion, and then also payouts and what accrual reports are generally what you would need. Oh, sorry, I got this twice. Okay, that helps me catch up actually. So, common issues, just no accrual done. And this is a common argument we can get from clients, especially that haven't been used to doing a payroll accrual, is that, well, I have 12 months of payroll expense. What's the big deal? I'm not accruing payroll. And we did have one client where it became a big deal because their general fund really was in a bad spot where they really had minimal fund balance. So just recording of the accrued payroll made a big difference in how much fund balance was available. So we had to kind of get them, sorry, you need to record it this year. You have a whole payroll period that you need to record. So you just want to record it. Because it can create an issue, or it's missing some amount. So you have to consider overtime, other pays that you need to make during the year. Sometimes you can make an argument of why you don't want to accrue overtime. For example, like your July 4th, there's a lot of police overtime being incurred for fireworks and so forth from the fire department. So accruing overtime may not make sense, but something to consider. Reconciling errors. So this is something we look through our lead schedule of all the payroll liability accounts, and then we see all kinds of things going on in here. Large negative balances, so large debits, large credits. Essentially, these accounts are not really being looked at each year. They're supposed to clear to zero. Like once you perform a payroll, they go up, and then once you make a payroll disbursement, they zero out. So if they're not reviewed frequently, you're going to see all kinds of mess in there. So it's something that you do want to kind of incorporate as part of your closing procedures. And pension and OPEB, I'll just, for the time's sake, I'm just going to mention kind of everything at once because they're really the same, in terms of what you need, they're really the same types of documents that you'll be getting for both. You want to consider all your pension plans. So some you may have CalPERS, some of you may have some single employer plans. You do want to get an actual report for all your plans, all your defined benefit pension and all your defined benefit OPEB plans. You want a schedule of your current year contributions made to the plans. If you have a trust, generally there is going to be an audit report that you need to obtain that we also obtain from you. And when we perform the audit, essentially it provides us audit evidence that the plan assets are appropriate. If you have multiple reporting units, so if you allocate pension and OPEB to your enterprise funds, for example, you have some kind of allocation that you need to perform. And then also your adjustment worksheet that you prepare to determine how much you need to adjust these balances each year. Issues. So a big issue is also delay in obtaining these actuarial reports, and it's usually because maybe it was forgotten or left till the end. That it's something that you then contact your actuary in July or August for these reports. They tell you that sorry, we're really busy. You'll get them in November, and now that's going to create a big issue in terms of you issuing your financials and having a happy holiday So really, you want to get in touch with your actuary early, have that written down and scheduled that you'll reach out. Sometimes they don't need to do a full valuation; they only need to do kind of an update. So depending on the year, it's more work than it can be more work or less work. Allocation errors. So usually we find that our clients, they annually kind of determine, okay, what was the payroll contributions or employer pension or OPEB contributions from each fund each year, and that's what's used to calculate an allocation percentage. But you really don't want to update these percentages every year for very immaterial amounts, because then what ends up happening is that one year you're recording, say for the water fund, an allocation using 20%. The next year using adjusting it by 21%. The next year you're adjusting it by 18%. What ends up happening is that all of the different balances at the end of the year, your deferred outflow, your liability, your deferred inflow, they're all kind of some kind of combination of all of the percentages. So really it creates a skew. So only update these percentages when they're really material or warranted. And if you really need to change those allocation percentages, the accounting becomes a lot more complex if you want to do it really correctly, inappropriate with the GASB. So that's something that you probably want to check with your auditor or check with us to see how that needs to be accounted for if you do need to change those percentages. Not incorrect contributions. So usually, because of the timing, your actuarial study may not have the current year employer contribution. So this is something you need to either run from CalPERS or have run from your payroll system. So if you don't record this amount accurately, it causes issues in following years, because then this is the amount that gets reflected in the liability. So you want to make sure these other types of pension contributions, such as your payment for the unfunded accrued liability, are included. And you want to reconcile this amount back to your payroll system, and then also maybe reports from Cognos from MyCalPERS. Actuarial assumptions. So even though you do rely on your actuary to come up with the assumptions, they do assume that some of this information that you've told them, or maybe things from prior year, are accurate. So if you have funding changes, so maybe you had plans previously to fund your plan every year, but maybe now you have budget constraints and that's changed, where you're not going to be actually making any additional contributions, especially for your OPEB plans. That will then impact what they decide is an appropriate assumption. So sometimes what can happen is that we as the auditors come later, and then we know this additional information, and then we say, well, it's not really appropriate for you to have that. Just make sure. Okay, I might go a bit over, hopefully not too much. Long-term debt, key documents. So, analysis of the long-term debt activity from prior, debt agreements, amortization of your premiums and discounts. You want to consider if you have refundings, your gain or loss from refunding. You want to have some kind of reconciliation included to your debt payments. So obviously what's reflected as your debt payments needs to agree to this schedule. Not to forget interest payable. So this is only required for the proprietary funds and fiduciary funds, but there is a conversion entry for the government-wide. So it really needs to be performed on all debts. And generally, you would use your debt amortization schedules to determine what needs to be accrued back as interest expense in the prior year. So you need to have some kind of work paper that you prepare every year for interest payable. New debt can be challenging. Generally, you're going to have some kind of agreements, and let me see. I might need to maybe just open this last one. Generally, if you have if I have a refunding debt, I might be falling really behind. So I'm not sure.
We're out of time.
Yeah.
How many slides do you have left?
a couple.
Okay.
Yeah.
All right.
And how long is when does the next session start? Or it's already supposed to
Yeah,
start?
in 3 minutes.
Okay.
But
Uh,
you can maybe take like
5 minutes.
5 minutes.
Yeah, let me take 5 minutes to wrap up. Apologies, I think I may have taken much time in the beginning. Um, but if you have a refunding debt, that would generally require a calculation. It's quite complex. Something you probably want to include your auditors in that conversation. And also, if you have debt covenants, reserve requirements, net revenue requirements, you want to probably prepare some kind of schedule or calculation to demonstrate compliance with your significant debt covenants. Challenges with and errors with long-term debt. So similar to capital assets, the beginning balances are not agreeing back to the ending balances of prior year. No consideration of original issue premiums or discounts. Current portion is incorrectly determined, so you may have a new amortization schedule, or you make sure that you're only picking up the principal for your current portion. If you have any new debt, including SPIDAs or lease amounts, you want to consider those. And then if you have a refunded debt, even though that debt may not be completely extinguished as of the end of the year, it may be still considered legally defeased, but it's still outstanding. You want to make sure this refunded debt is removed from the schedule. Other calculation errors, interest payable is not updated. And then I think when you have a refunding, it's just a very common issue where we find errors in that refunding gain or loss calculation, or we find the refunding gain or loss was not even recorded. It was just run through expense. And then also you want to consider leases, SPIDAs, and other debts. I'm just going to skip through other liabilities since they're not really that significant, similar to deposits and prepaids, issues that you normally want to obtain or schedules or of these balances as of the end of the year. You want to reconcile them annually. And usually we find that either they're not updated or not really considered. And then also sometimes you need to obtain information from other departments. So you may have public works that maintains information of your deposits for different projects. These schedules that they maintain in Excel or other systems, they're not reconciled back to your trial balance. Okay. And then with unearned revenue, you want to consider any monies that you received in advance that they shouldn't be recognized as revenue. When you receive them, they would need an additional entry to defer those revenues if they are unspent. Right. I think I talked a lot initially about the significant revenue accounts, so I might skip this, but just something that you want to prepare every year, especially for your large revenues. Not necessarily every single revenue account, but property taxes, transient occupancy taxes, possibly your UUT, if you have large grants, cost allocations, capital project funding. I think we talked about missing revenue, allocation entries not recorded. So just because it's an entry that there's no trigger to kind of let you know that this is something that needs to be recorded unless you compare budget to actual. It's something that can be often missed. And then also with your capital project expenditures, because you have multiple funding sources, your gas tax fund, Measure B fund, or Measure A fund, or measure, whichever the transportation measure you have, you want to make sure that you include your project managers in these discussions to determine what's the appropriate funding, and then make sure that these allocations of funding are recorded accurately. It's not often that we find that these are some of the subsequent corrections that come later, usually come from your side, that an entry is needed to correct the classification of expenditures to the appropriate funds. I think I talked about fund balance a lot, so I'm just going to maybe skip through that. I think we talked about this in the beginning of the presentation. I'll just have that for you. The materials have been forwarded to everyone, so you should see these items for your reference. I think we talked about deficit fund balance being an issue, so skip through that. Talked about GASB 54 and transfers not being recorded. Right. There's some other pointers to consider. So financial analysis, as I mentioned, you want to kind of look at the financial results once you're done with all the entries. Are they what you expected? Can significant fluctuations from year to year be really explained, or are you having a challenge really explaining why police department expenditures went up by 30%? Or usually these are things that you trigger, okay, we need to take a closer look and maybe do a correction entry. Materiality. So you shouldn't use our materiality as the auditors. Our materiality as the auditors is really based on your materialities being much smaller than ours. So when you use our kind of level of materiality, that really raises our audit risk. But just review your materiality thresholds for accounts payable, for example, or receivables. Not every single thing needs to be accrued. You can kind of pick and choose depending on the volume of the transactions. That's where you want to judge what's appropriate. Staggering the closing process. So as I mentioned, can anything be done during the year? Especially for capital assets or other types of reconciliations. And so really staggering the process will help you at year end. Review prior year. So looking at the prior year audit, was there any entries that you gave the auditor their trial balance, and then subsequently you gave them a lot of entries? And did you have any audit adjustments? These can all be incorporated as part of your closing process. You don't need to have them recur every year. We won't be sad that we don't have to give you any audit adjustments. We actually like it when we don't have any audit adjustments. It makes things very easy for us. And then also incorporate our audit requests. So as part of your closing schedule, if you're working on accounts payable, in your accounts payable, you can incorporate things that we've requested, like subsequent disbursement registers, outstanding purchase order reports, and so forth. These can all be kind of done together. So once you're done with the closing process, you've also considered us and you're kind of done with the audit requests preparedness process, and you're ready to go. And then if you have any questions on our requests, these can be incorporated. Communication is always helpful. All right. I'll skip this slide. It's for your reference, but this is just a summary of what you probably want to consider. Have a standardized process, use checklists and templates, utilize technology when you can, train staff. The more people you have involved, the less turnover is an issue. And then also look at this process annually and just update it and incorporate any changes if needed. And this is the reference for the examples from the GFOA. I'm not sure if I have time for questions, but if there are,
I don't think so.
yeah, sorry. So I apologize for going over, but
Maybe in
yeah.
during break or something.
Right, maybe during, if we have time in my next session, I'm happy to answer any questions. Sorry.
Was great presentation.